Hey traders, welcome to Charts and Coffee. Hope everyone's having a good morning. Although CPI has been definitely wreaking havoc with the, I won't say uptrend that we had yesterday, but at least some of the stability. Let's go take a look at where CPI lands. We'll start there, and then we'll move on to, of course, your questions, any symbols that you've got an eye on, and what is happening right now, right? Because I know the last week or so, I think from last week into this week, we've definitely seen some shifts. And any kind of shift in behavior is always going to be a little bit of a pain point. So, and these aren't going to happen often, but they are going to happen. So we'll talk about how we identify them, what's going on right now, and we'll go from there. All right. So first of all, you see, we've got a little list here, CPI aftermath. That's not really just the sell-off that we saw in the broader averages. It was pretty darn swift. Obviously, the CPI number was not one that traders think is going to encourage Fed cuts sooner rather than later. But let's talk about where we are, 34 minutes after that number. This is the measuring stick, by the way. It's not the S&P. It's not even bonds. This is a futures contract that reflects what's happening in a contract called the Fed Fund Futures. Their only job is to look at the different meetings where there's a contract associated with each one, and then look at that meeting and say, are they going to cut or are they not? And then they factor it in with the futures contract. Now, May has not been a cut month for a very long time. So the fact that that's up where it's at, no surprise, no major shift. Then you move on to right here into June. So when we move to June, June is interesting because the expectations for the hold are, as you can see here, 74%. June was on the fence anyways, and now it's clearly starting to move to off the fence, meaning if we look at where the current 525 look is, it was a lot more, maybe they will, now it's they won't. And obviously equities are not going to love this. So no cut in May, and now it's looking more and more like no cut in June. Okay. But that's not really the main thing, because slowly expectations have been moving out to July. This is the problem. And gang, you might say, Rog, are they going to cut? This is our opinion, right? This is our opinion, meaning traders are saying the Federal Reserve is not going to cut until possibly July or September. They have made pretty clear they're going to cut. But they, meaning, well, I shouldn't say they, Powell has made pretty clear that they're going to cut. They just don't know when. And they've always been, in fairness, saying we're data dependent. So if inflation is running steady, which in fact it is, right? Some people might say inflation came in hotter than expectation, right? Not in terms of the data plotting from the previous to the next and the previous to the next. Expectations are where we think they might be. If you look at a moving average, if you will, of inflation, it stayed pretty much steady. But it certainly isn't enough to convince traders to overwhelmingly expect a cut in July. Equities are not going to like this. Bond yields are going to head higher while the bond contracts, ZB, move lower. And frankly, this is the problem we have right now. Let's take it to the charts. What is going on? For pretty much most of the last, frankly, 6 months. Let's just go back 6 months, right? For most of the 6 months, we have been steadily trading above certain key levels, right? Whether that be a 200 propulsion, whether that be just generally stair-stepping higher along sometimes the mean reversion, most definitely along the daily price movement range. This has been what we've been dealing with for 6 months. And frankly, if you've been following Charts and Coffee, if you've been in the Sector Secrets Mastery, we have been steadily growing an account throughout this year. And actually, we had very good bullish trades at the end of last year into Q4 because the trend was already establishing itself, because the anticipation, right? The anticipation of the rate cuts. Take a peek here. This is back here. This is October. Got back above the 200, and we haven't really looked back. So that's why I'm kind of going back. Well, it really should be November, December, January, February, March, and now into our 6 months. So 5 months. All right, so for 5 months, this has been an extremely good environment for account growth. And I realize that we care about what's happening now, but what happened before matters. Because when we go into chop, if we're continually staying with the trend, that's what the top tier does. This is really so much of what I'm trying to convey to traders, if not have been pleading throughout this year. Please, while the trend is up, buy the dip because it won't be forever. We're going to have chop. We're going to have potentially more deeper mean reversions. But while it was, right, now it's not, right? So if you're looking at your account going, I missed this. Yeah, for now. And I say yes, not to hurt anyone's feelings, but to say the next time the trend resumes, the next time the top tier goes green, the next time we have steady green grab candles, that's going to be your next opportunity, and it will come. But the problem is now we have to transition. One of my mentors told me a long time ago, don't always try to spin a bad trading decision into some lesson learned or tuition to the market. He said, don't do that. He goes, let it sting. This is what my mentor told me. And this is what I'm passing on to you. This is why I'm here 3.5 decades later, right? He said, let it sting and don't make that mistake again. Don't let other people cloud your judgment. Trust your process, follow your process, and continually test it to make sure it's as good as it can be. So I'm passing that on to you. That's not popular advice. But then again, successful traders are not that common either. And because we kind of have to take this tough medicine by the spoon, by the bottle full, right? And that is right now, that trend is wobbling. So I'll still look for long opportunities. This is still bullish, but it's chop. It's not the trend that we've seen since, frankly, excuse me, November, right? So if you look back and say, gosh, Rog, I was listening to people that say this was the beginning of the end. And I was listening to people saying I should short this market, or I should short every high, or whatever. That costs you money, right? And that wasn't what participation and price were indicating. We were in the bullish hemisphere. We still are. That's really important to remember. And our world is so much bigger than just the S&P, isn't it? I mean, really, isn't our world a lot bigger than the S&P? So I have to sneeze. I try not to in live. I think it's going to pass. Okay. So we do have trends. And let's talk about where the opportunity is right now. Okay. So we do have trends. Everything is going to be susceptible to the disappointment of the adjustment that we have to make. You know, if people look at me and say, Rog, how long will you continue to expect Fed cuts? Until Jerome says that he's not going to, because they have said they're going to cut. They just don't know when. So am I still looking at 3 rate cuts by the end of the year? Yeah. Am I still super bullish for the remainder of the year? I'm bullish chop right now, but I am anticipating a reorganization to the upside. By the way, why wouldn't I? It's grown my account for 5 months. If you've been in the Sector Secrets Mastery since January or February, it's grown your account for 2 to 3 months. So why would I abandon that and start shorting highs, right? That's the psychology that A, keeps you on the sidelines, or B, costs you money because it's an opportunity cost, right? Remember, clickbait is, oh my gosh, the end is near. Trading is not that dramatic, right? There's no drama in that. Just follow the trend. The trend right now is subsiding in the S&P, the NASDAQ, the Dow. It's not in the energy sector. So take a look at XLE. We are not seeing trends wobble all that much here. XLB has been steady. Now, all my cards on the table, I've got a long position in XLB. By 10 a.m., I'll know if I have to cut this or not because it just got swept up in, quite frankly, a pretty significant overreaction. Markets like to throw a tantrum. You know, look, if we all think that the markets are so smart, that means we think people are smart. I think a person is smart. Generally, and we all know this, a person is smart. People are dumb and very apt to drama. And that's what we're seeing playing out. And by the way, we play people. We play people's response to monetary policy. We play people's response to earnings. So a lot of the volatility we have in this environment is that more so than ever, we've got the information. We're getting it. Even the most sort of hobbyist retail trader has got information they didn't have at their disposal in real time. even 20, 25 years ago. So that's a lot of the evolution of the retail participant. They're a lot more active, a lot more active, right? So that's XLB. We still are looking at Freeport McMoran, BITO. So my thought was to to take a couple of positions that were on the sort of the fringe, if you will, of the overall movement. So being on the fringe of it means, I'm not going to be an S&P. I'm not going to go look at XLF or stocks that are heavily weighted in the broader averages, but rather trends that are a little bit more on the periphery. So we'll see how those look at 10 o'clock. And I'll wait. And I always wait until the end of the clearing before I cut a trade. And was really a real bummer about XLB was that it was a nickel. It had a very good surge into the second half of the day yesterday. It was a nickel from our target. So, sometimes that's just the way it happens. And in these macroeconomic, monetary policy sensitive, if not confused times, this is what we're dealing with. And it's not fun. This is what transition feels like. And by the way, you might say, okay, Rob, we know what it is, right? We know what it is. How do we adapt? Great question. That's something we're definitely going to talk about a lot in today's webinar. So if you haven't registered already, Top Tier Pro, actually it's Top Tier Pro system. If you want to go to Top Tier Pro class, that's where you can pick up the class, which is happening this Saturday. If you do not have a plan for how to recognize 5 months of trend, if you're going back and saying, Rog, I didn't grow an account for 5 months, you've got to be at this class. Rog, I didn't recognize we're going into chop. Again, got to be in this class. More importantly, Rog, how do I recognize when the trend resumes? And it's going to, right? And it's going to. There's a lot of reasons, and I'll get into some of that tonight. There are a lot of reasons where we can look at data, right? Not emotion. We can look at data and say there is a lot of reason for the trend to resume. And so I'm actually going to touch on some. I was doing a little bit of that research this morning. Aside from CPI, we have to look at some bigger picture, because let me put it this way. The money can't go under the mattress. Everyone gets that, right? If we're scared, where do we go? There's always going to be flow somewhere, right? It may not be into the S&P. Right now it's energy, basic materials, oil and gas, explorers, oil services. We have a number of trends that are still intact. So money does not go under the mattress. It's then our job to find, all right, where is the flow, right? It doesn't stop. It just finds somewhere to go, like water, right? This is where I should quote the Bruce Lee. It's got to go somewhere. So that's our constant job. It may not be going into SMH and NVIDIA like it was. It may not be going quite as swiftly into communications like it was, right? Although communications are still pretty strong. Definitely something to keep on the radar. Financials, definitely something to keep on the radar, right? But these volatility events are going to happen because the broader averages are getting very wobbly, and they're getting wobbly because it's not that monetary policy is not going to change. It is. We don't know when. We don't know to what degree. The choppiness comes from confusion. When you see chop, take the chop suey distribution, take that away for a moment. What is it? It's confusion. When we have certainty, we have trends up or down. Certainty is great. Certainty is extremely profitable, which is why I say when the structure is green, please, especially that very nice steady run we've had so far this year, right? Please take advantage of that, right? Don't dismiss it. Don't naysay it. Take advantage of that, because what we have right now is inevitable to come, right? And we've been talking about this in the mastery, saying, hey, look, this is a great run, but chop will come. It's so important that we build our account so that we can handle what's happening next. And of course, this isn't a matter of blowing up an account. We're going to take smaller losses. We'll have fewer trades that are going to follow through, and we'll have some trades that follow through beautifully. We're still managing a long Freeport McMoran trade from the end of March. So not everything is falling apart. It's just fewer things are available for buying, which makes it all the more important that we have a process to find those things that look like GLD, that look like Freeport McMoran, right? Okay. So it's not a matter of better. Java, why would I want to pick? right? Great question. I can appreciate the question, but question is, what's better, GLD or USO? Set them both up. Why should we have to pick? They're two different things, right? Gold is a play on real yields, and oil is a play on, oil, supply, demand, economic optimism, OPEC, energy policy. I would say if you want to avoid today some of the melee around real interest rates, meaning what are bond yields doing? What's the rate of inflation? How are they going to react? And therefore, I'd say focus on crude if you want to avoid some of the macroeconomic melee in the wake of CPI. But as a general rule, focus on both. We're in a 5x winner. We're in a 5x winner right now in GLD, right? So we bought options at about $3.55. That's as of yesterday, we're closing in on $18 per contract, with still 9 days to go till expiration. So the opportunities are there, but yes, it's a smaller pool, which means we need a process to find them, right? Okay, so let's say what else we have here. Yeah, so ultimately, I'm still looking at this market as a 5-month uptrend that's going into a little bit of a transition, confusion, chop, distribution. The higher likelihood of follow through. Let's talk about this as well. If we take a look at the last time we kind of chopped around, again, we play probabilities. I'm not here to predict where the markets are going to go because, frankly, I don't know, right? And by the way, does anyone listening to me actually think there's a grown adult here that's going to predict where we're going to be in 6 months, 6 weeks? No. I can tell you, the longer you go out, if someone were to say, Rob, where are we going to be in a year? I'll probably say higher. That's easy, right? It's an intermediate. Where are we going to be in the next few days? Where are we going to be in the next few weeks? Where are we going to be in the next few months? That's far more difficult. And that's frankly not even our job, thankfully. But take a peek. Here, that was a pause. It was a very small pause here, but we never even lost that bullish momentum. Here, another pause. What happened here? Resumption. I'm going to play the probability of continuation, not reversal. Most traders like to play this idea that this is the top and we're going to reverse. They were wrong in January, really wrong, and they're likely going to be wrong in April, right? So remember, we have to change the way that we're looking for setups. We have to go from trend following strategies to now bullish chop strategies. And everyone should have these toolkits available, right? It's who here golfs, right? And I know I'm running over. Who here golfs? Do we just golf all 18 with one club? No, we know that there's a club for every shot. And the more skill we have, the more we can use all those clubs, right? And that's really where we are as traders. The more skill we have, the more ways we're going to have to take advantage of bullish chop. But the number one job is to know where we are right now so we can adjust, right? So that's why I say, funny enough, it's so much easier to talk to traders and teach traders when the markets are doing great. But the fact of the matter is, I love when markets get tough, right? This is our hell week. This is where we learn position sizing, risk management. This is where we get good when everyone else is just sort of complaining, whining, drama, blaming the Fed, blaming out. No. We say, you know what? If we can learn to manage this, we can trade anything, right? That's why traders in 2020, most of them aren't here anymore, because you don't learn anything when things go straight up. Now we get to do a lot of, hey, what have I learned in the last 5 months? Thankfully, we've built up an account. And now how do I handle chop? And how do I get ready for that next leg? So we're going to be talking about a lot of that. What tools do I use to do that? Because if I don't have a dashboard of tools that tell me what's happening, I can't make the adjustment, right? Okay, so I hope that makes sense. I will see you all tomorrow, same time, same station, and we'll see what today brings. All right, be good to each other, gang. I'll talk with you soon.